One of the biggest secrets to building wealth is understanding how to make money work for you. And that's why the SCHD ETF is so popular today, boasting an impressive 10-year track record of 11.5% and a dividend yield of 3.5%. Another key reason for its popularity is its focus on quality and consistency, offering a steady income stream for investors seeking regular cash flow. However, recent market dynamics have prompted investors to reassess SCHD position as a leading dividend fund. Some investors even have expressed regrets over their recent purchase of SCHD. Therefore, the main question is, will SCHD remain the best dividend focused fund as we head into 2025? Or is there even a better one? So in this video, we will discuss number one, how SCHD selects high quality dividend paying companies using strict screening criteria. Number two, SCHD diversification strategy, which ensures balanced exposure across stocks and sectors. And number three, whether SCHD remains the best dividend fund for 2025 and beyond based on its performance and strategy. Because we have all seen an impressive bull run with the S&P 500 gaining 92% over the past 5 years. And therefore, many investors have wondering if they should step out of the market for a little while and secure their returns. Because they are noticing that some of the best investors, like Warren Buffett, for example, are holding back and keeping cash on hand, a topic we've discussed in this video. So to answer this question, let's go directly to the source of SCHD. We see that the fund's goal is to track the total return of the Dow Jones US Dividend 100 Index. So while this might sound like rocket science to you when you are new to investing, it's important to understand what it means. The fund is tracking an index called the Dow Jones US Dividend 100. So we need to understand how this fund operates. And here I found a really detailed breakdown on Reddit with the methodology of SCHD. The index universe consists of the stocks in the Dow Jones US Broad Market Index, excluding REITs. There are three initial screening criteria for this selection process. Number one, minimum of 10 years of dividend payments. And this is essential because for most investors, the primary reason for choosing SCHD is the steady growing dividend payments. And a track record of dividend growth is a good indicator of its commitment to continue paying dividends, right? Number two, the minimum float adjusted market cap of 500 million US dollars. And number three is the minimum 3-month average daily trading volume of 2 million. And step one is challenging to pass, with an approximately 92.6% of companies failing. Step number two is relatively easy and serves to filter out about 20% of US companies. And step number three requires a minimum 3-month average daily trading volume of over 2 million per day. And step four is also easy, filtering out another 20% of US companies. So as a result, the universe of stocks is narrowed down to just over 300 companies. And these filters create a pool of high quality companies. But how does it go from 300 solid choices to just 100 exceptional companies? And the answer is math. Only the top 50% with the highest starting dividend yields qualify for selection. This screening process helps SCHD maintain a higher than average starting dividend yield. After that, the remaining stocks are evaluated based on 4 key metrics, and these are as follows. Number one, cash flow to total debt. Number two, the return on equity. Number three, indicated dividend yield. And this shows the expected dividend yield, a key metric for income-focused investors. Number four, 5-year dividend growth rate. This metric identifies companies with a strong track record of increasing dividends over time. So if you would like to access the metrics that SCHD uses to calculate this top 100 companies, I will share the Word document with the link in the comments below. So if you enjoyed this video so far, don't forget to subscribe and stay up to date for more tips on how to grow your wealth smarter and faster. So SCHD's historical double-digit dividend growth rate, and that's a mouthful of words, demonstrating success of this selection process. The top 100 stocks are chosen for the index, with each stock capped at 4% of the total index and sectors capped at 25%. Why is this important? The reason why SCHD caps individual stocks at 4% and sectors at 25% is to ensure proper diversification and reduce the risk of being overly reliant on a few large companies. And I think this is especially important when compared to the S&P 500, for example, where a handful of massive tech companies can have an outsized impact on the index performance. And this can be good, but also bad. And I see that a lot of clients who are investing making the wrong choices about diversification. So please be careful with this. The S&P 500, for example, has seen around 31% of its weight concentrated in just 7 massive tech stocks. And typically, when you invest in an ETF, the main goal for most investors is to achieve proper diversification, right? But this creates a situation where the performance of the entire index is heavily influenced by those few companies. Therefore, SCHD offers a more balanced approach, protecting investors from the volatility of a few dominant stocks. Another important feature of SCHD is its annual reconstitution, where all stocks in the portfolio are re-evaluated once a year. For instance, here you see the list of reconstitution of the industry where utilities drops by 1 and transportation got added by 1. But what you also can see is that the recent reconstitution led to changes where 23 companies like Bristol Myers and Hershey Foods got added and 23 companies got removed. Now let's address some common concerns. When comparing SCHD to S&P 500 over the past year, the S&P 500 has risen almost 38%, while SCHD has gained around 29%. This is an important difference, and here are a lot of investors making a big mistake. They compare price returns but not total returns. And therefore, total returns include both the change in share price and also the dividends or distributions that were paid out. However, the S&P 500 did better over the last years. And a key factor in this outperformance is the performance in the tech boom over the last year. Looking at the heat map of the S&P 500, tech stocks have performed exceptionally well. Nvidia is up for 192%, for example. Amazon has risen 35%, and Google's up around 28.8%. By contrast, SCHD tech allocation is just 10%, much lower than the S&P 500, which explains why SCHD has lagged behind during this tech-driven rally. And therefore, when the market has seen an incredible bull run over the last years, SCHD offers substantial downside protection. But as Jack Bogle once said, you shouldn't choose funds based solely on past performance. However, it's still valuable to understand how a fund has achieved such strong performance over a long period of time. Since SCHD inception on October 2011, it has delivered an annualized return of 13.3%, and that's amazing. So just to be clear, I am not against the S&P 500. It's an excellent investment for many people. However, recent years the market cap weighted S&P 500 maybe is not as diversified as you might think. Once you realize this, you will be in a better position to make the best decision that align with your personal situation. So if you are looking for a decent starting dividend yield, dividend growth, share price appreciation, and downside protection, in this video we will explain SCHD in more detail about the performances, diversification, and so on. So let me know what you think of SCHD in the comments below and like our channel to receive more videos like these. See you in the next video.